So appreciate everybody joining tonight for our Transformational Tuesday. Got some interesting things that I want to talk about tonight. I am going to put in the chat my contact information. Um, Always love to have people connect with me. Can you just give me a thumbs up? You can see my screen. Awesome, perfect. Thank you. All right, I guess I can take my message that says hit record off of there. I always want to make sure that I get the record button. So today we're going to talk a little bit about passive investing from confusion to clarity. It is September the 23rd. I will be making this announcement a little bit later, but we're going to switch from twice a month to just once a month on the second Tuesday. You'll get an email update about that, but we're going to just do this once a month. And if you ever have any topics you'd like to see discussed, please just send me a note. Happy to do them. As always, this is an educational series. I am not your financial planner. I'm not your lawyer. I'm not your accountant, but I'm here to tell you what I believe to be true and accurate. But you always must do your own due diligence before making any investment decisions. So a little bit about myself. I started passive investing in 2018. I've been a limited partner in 20 syndications and a general partner sponsor in 14 syndications for a total of 34 syndications. A little bit about Massive Capital. We're a vertically integrated real estate company. We're a developer of Class A retail and town centers, and then owner operator of value add multifamily. So we raise retail from individuals and family offices. We do triple net leasing brokerage on our commercial real estate, land development, steel frame construction, and then we do have the Massive Masters, our mastermind. We're very focused in Texas market, but we do have assets in Colorado, Georgia, and North Carolina. Our partner on the retail side has about 300 million in assets under management, and Massive Capital now has about 210 million in assets under management. Tonight we're going to talk again what's a syndication, GP, LP, blood in the streets, fear, time to be greedy, why multifamily still makes sense to invest, finish the year strong, and then it's always open for any questions that you might have.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
So as I mentioned before, a couple of you have been here before. I was always interested in monopoly as a child. I always knew that the people that bought the houses, converted them to hotels, won the game. But when I became an adult, I forgot about that. And I didn't do anything in the real estate space. And I knew I wanted to, I knew I was interested, but what did I do? I kept trading my time for money and going around the monopoly board. So again, always interested in it, but I always believed I needed to be a millionaire to be able to invest in commercial real estate. I did get a payday, started looking at it and realized I didn't need to be one. There was a way that I could do fractional ownership. So again, your active income, you work for your money, you get your job through self-employment, and it requires time, work, and energy. When COVID came along and they let me go, guess what? They stopped paying me too because I stopped showing up for work. So passive income is where you put your money to work. Your money works for you. You invest in money-making assets or businesses, and it does not require time or work. So again, we all know where people are told to put their money, right? We're told save our money in cash savings, but you get no cash flow, no leverage, no real assets, no tax advantages. And in fact, in high inflationary times, you're losing money, saving money. On bonds, you can have some cash flow and some tax advantages, but you don't get to use leverage. Stocks, you will get some cash flow and you will be able to use leverage. But of course, you're rarely buying real assets and you're rarely getting any tax advantages. Real estate is the creme de la creme. You can get cash flow, you can use leverage, and we'll talk a little bit more about that. You're buying real assets, and then there are significant tax advantages investing in real estate. So syndications, we're going to talk a little bit about them, a group of investors who pool money to buy or develop real estate. Syndications are a way for investors to invest in larger properties they couldn't afford on their own. Syndications for the passive investors are totally passive. How it works, we have a whole group of general partners and sponsors, experienced real estate professionals. We organize the syndication, secure the funding, and implement the business plan. Limited partners, they come in and they help fund the project and they own a portion of the asset. So again, I'm going to give a really simplified explanation. Let's say we're going to buy a $10 million commercial real estate. We're going to get about $7 million in loan or 70% loan to value. And we're going to need to raise the other $3 million from our passive investors. So we have 70% leverage. The passive investors invest 30%, but actually they end up owning 70% of the asset we buy. So it's a super way to kind of double use your money, right? So we're using leverage to buy it. And then obviously we're leveraging your money to go ahead and complete it. So what happens is when we make a dollar, 70 cents gets split up to the passive investor, 30 cents gets split up to us as sponsors. So that's how we make our money. We sometimes will obviously invest as limited partners in a deal, but we make our money on what's considered the general partner split, which is a 70-30 usually. You have a limited liability. So you're not signing the loans. You're not responsible for any insurance. You're not responsible for anything. The only thing that is at risk is your original investment. It allows you to focus on specific projects. So you don't have to understand everything. You know, I just did a raise, and we talk a little bit about it a bit later, on an RV park. I really didn't know much about RV parks. So I had to obviously learn about it because I was promoting the deal, going to be part of the deal. But I went with somebody who was an expert in the space and they understood the space. They knew how to underwrite it. Part of our mastermind mentorship, there's one of our team leaders in there owns about 5 parks, and he was able to advise them. So I could target my investments. And then, as I mentioned, the returns are directly tied to the success of the project. So again, as a sponsor, I don't get paid until you get paid. And so we normally have a 7% pref. So you're going to make money before I get paid. And then after we've met that pref, it's a 70-30 split. So it's definitely tied to the success of the project. So again, there are some rules for syndications. There are 506B, and we start a lot of our opportunities as 506B. And in fact, when we have these opportunities, I actually can't talk about them on this call because we have to be able to have an existing relationship because these get uploaded on YouTube and different things. So we need to have that pre-existing relationship. So if we don't have one, you need to make sure you get one if you're not an accredited investor, or you just like to see the deals early, and you have to be considered a sophisticated investor. And that's part of the reasons why I do these calls. We're also only allowed 35 non-accredited people. So again, if you think we were raising that $3 million, if 30 people put $100,000, I'm not maxed out. But let's say 60 people put in $50,000. If those folks are not all accredited investors, somebody's going to miss out because we're only allowed to put 35 non-accredited investors into a deal. And again, I already mentioned it, no solicitation. Now, we do switch our opportunities to a 506C, and in the past, most deals were 506C. There was no way for the general public to be able to join these types of deals. So as an accredited investor, you have $1 million in assets excluding your home, or personal income of 200, or family income of 300, and there are no restrictions on soliciting. So once a deal turns to a 506C, I can post it on LinkedIn, Facebook. I can talk about it on this webinar. And just to know, there is no difference between a 506C or B or a C, only who can invest and can I advertise it. So again, if you're interested in learning about 506B opportunities, we need to have a conversation. I just put you on a wait list. Doesn't mean that you're going to invest. It just means I check you would like to learn about the next one so that you do not miss out on any opportunities. So as I mentioned before, we did our RV park. We actually never switched it from a 506C to a B because the raise was super successful. So again, we purchased it for $3.6 million. We did a target raise of 2 million. We actually had commitments of 2.5 million in 14 days. So we were fully funded. And in fact, some of that money came in the same time. So we had to refund two people some money. We were able to leave them in the deal. So again, some of our opportunities can fill up really quickly. So don't miss out. Again, if you don't find a way to make money while you sleep, you will work until you die. So this is my chart that I love a lot that talks about being able to grow your money. So our goal is to double your money every 5 years. I've taken tax consequences out of this scenario because everybody's tax situation is different. But if you were to invest 100,000, double it to two, then you invest the two, double it to four, four to eight, eight to 1.6, 1.6 to 3.2 million. Again, pretty lofty assumptions. You always doubled it. You always had an investment and you had no tax consequences. This is just from one original investment. And then you're reinvesting the 100 you made plus the 100 you had. You grew that 100 to that 200 to 400. So again, it's only starting with $100,000 in cash. So this is why I say commercial real estate passive investing. It's not a get rich quick, but it's a get richer slow because you can see how your money can compound. And again, first rule of compounding is never interrupt it. So again, my favorite guy here, Mr. Warren, you'll see I quote him a lot. This is the power of compounding, right? This man is smart. This man knows what he's doing. He doesn't actually invest. Lately, he has started investing again in real estate, but he's investing in companies where he's putting his money to work. His money's always working. I saw somewhere that he makes like $1 million a day on Coca-Cola. I'm not supporting him. I don't like Coca-Cola. I try not to drink sodas, but it's amazing that he owns enough of that to be able to do it. So why are people not doing commercial real estate investing? Why have people decided not to do passive investing? They're afraid, right? So they're fear of failure, worried that a new endeavor might not be successful or meet expectations. People are afraid. They're afraid to lose their money. They're afraid that they don't know what they're doing. They're afraid that they don't understand it. You feel overwhelmed, right? You're unable to manage the scale of complexity. I just don't know everything there is. And again, I was that way for a long time. I just didn't understand it. Therefore, I didn't do anything. Then as I started to learn, I suffered from perfectionism. Until I really understand everything, I just can't do it. Or until I know everything, all the facts, I just can't do it. And what does that lead to? Procrastination and analysis paralysis, right? So we talk about it all the time. When is the best time to plant a tree? 20 years ago. When's the next best time to plant a tree? Today, right? So self-doubt. I don't know if I can do this. I'm not sure if I want to be able to do this. I don't have the skill set. I don't understand it. And that's the beauty of syndicating, right? You are investing with people that are experienced real estate operators. So the who is very important when you give your money. And then there's some social anxiety. What does the world tell us to do? Tells us to go to school, get a degree, get a good job, contribute to your 401k. Is that really the plan to be successful, right? 90% of all millionaires in the US are successful through real estate. Okay. So again, understanding it and then just not feeling I'm just not going to be able to handle this or do this or be able to figure out what I'm supposed to be doing. So again, this is a great quote from Baron Rothschild. Right now, again, it's a scary time, right? When there's blood in the streets, or sorry, buy when there's blood in the streets, even if some of that blood is your own blood. So this is one of my favorite quotes. Be fearful when others are greedy and greedy when others are fearful. I think Warren Buffett thinks it's time to be greedy now. He's invested about $1 billion in real estate in the last little while. So again, his investment in the housing sector is a strategic overview. So Warren Buffett's investment philosophy has been long-term, focused on sectors with strong fundamentals, right? Warren Buffett's not like go off and buy the latest, coolest fad, right? He is in companies or businesses or things that have a long-time financial structure. So in 2023, he invested about 814 million in DR Horton, Lenar, and NRV and VR, pardon me. And then he finally sold that stakes in those companies for a while. But what did he do? He's doubled down now. So he's investing almost $1 billion back into Lennar and DR Horton, and it reinforces that he has confidence that the housing market fundamentals are there. So again, he's looking for long-term potential despite market fluctuations, emphasis on stability, and growth in the housing sector. So this was a very interesting chart. I showed this one a little while ago, and I find this one quite mind-boggling. So this red line is average rents. Okay, now I wish I had something that went past 22, but I just can't find it. I don't know why it's not out there. But you can see rents went from about 225 to 1845. You can see rent steadily increases, right? So this again is good for those of us that own rental properties. Now this is mortgage on for a house, average mortgage payment, and you can see it popped up and it popped down. And even for a little while here in 2010 to 14, it was below. It was cheaper to buy a house than it was to rent. Really had low purchase prices, not a lot of appreciation. But look at this delta. Look at this, what happened in this period of time here. So the average rent was 1845. The average cost for a person to buy a house is $2,697. What does this mean? It means that the American dream of house ownership, I'm sad to say, is no longer around. People cannot afford to buy a house right now. Now, I don't know if it will change, but this is creating lifelong renters, people that are now entering the workplace, looking to stabilize. It is creating long-time renters. There's just no doubt about it. It's absolutely crazy. So again, this big delta here. And there was another interesting article, and I meant to get a copy of it for here. The next largest demographic of people that have become renters are the 55 and plus community. It's quite interesting. They've decided they want to cash out of their houses. They want the flexibility. They want the downsizing. They want the different things to be able to do it, and they want to be able to get those things. So I know some folks are saying they're waiting to be let in, but there's no waiting room, so I don't know where they are. I don't. Somebody texted me, so you guys got in. There's no waiting room, right? We're all good. So conclusions, right? Highlights long-term potential despite the market fluctuations. Emphasis on stability and growth in the housing, commitment to strategic investments in home building, and Berkshire's confidence in ongoing market engagement. So what can we learn, right? We can learn from all the different things. So why do I still think that investing in multifamily is a good thing to still do? Multifamily properties provide a reliable source of income from multiple tenants, right? So we all know this. Anybody who started in the single family space, you have one house. When the tenant moves out, guess who pays the mortgage? The homeowner, the person that's bought it to put it up for rental. You pay the mortgage. There's no ifs, ands, or buts about it. And if they do damage to the house, who pays for the repairs? So first of all, you've got a tenant that's out, then you need to be able to damage and get things going. And then next thing you know, they've moved out and you're covered it. But on multifamily, you have multiple units, right? So I've talked about this before. We have a property in San Antonio with over 200 units. So if I have 10, 20 vacancies, it's okay because I've got 190, 180 tenants still paying rent, right? And so even if one unit isn't vacant, the income from the other units helps maintains the cash flow and it reduces the financial risk. In I can't talk. In strong rental markets, filling vacancy can be relatively quick, minimizing downtime and containing or maintaining consistent cash flow. So again, when we have an apartment goes down, we have full-time staff on that do our turns, that make the units ready for able to be done, and they can go ahead and we get a unit done. We can usually turn a unit anywhere from 5 to 15 days, depending on the damage of it, and then get it back up on the rental market so that somebody can go ahead and move in. Long-term wealth building with appreciation. Multifamily real estate tends to appreciate over time, providing the potential for significant long-term equity growth. Strong rental demand and property improvements can contribute to this appreciation. So again, I want to go back over to, and I talk a lot still about the difference between single family and multifamily. So if I buy a house that has a 200,000 ARV, and I buy that particular property, and again, you're supposed to buy it at 70% of ARV, you're supposed to be able to do the renovations. That's how you make money in the rental business. Okay, and so I get that house and it's all fixed up and it's rented, and I get to increase the rent by $100. Did that house go up in value, or did my cash flow position improve a bit? The house did not go up in value. It's still in a neighborhood. It's still based on the comps. It's still based on everything that happens, and it's going to be worth what it's worth based on the comps. But on multifamily, because of the economy and because you're buying it as a business. So for example, my apartment that I mentioned with 200 units, if we can increase the rent $100 per unit, now it'll take us a while to get all the apartments up to that. That will go straight to the bottom line of the NOI because it's not going to cost us much more to run it, right? We've been all the repairs and things and done. So it's not going to cost us that much more to run it. That will actually add $4 million to the value of that apartment complex. So again, think about this. We bought that apartment complex for $16.9 million. And if we can pull one lever, which is get the rents up $100 for every unit, that apartment complex goes from being worth $16.9 million to being worth $20.9 million. That's the beauty of multifamily. That's how you can make multifamily continue to grow, right? Also, multifamily is a lot easier for financing and scaling. Again, I got a lot of friends in the single family space, and they basically cap out. And then they have to go and get the SCR loans, and they're a lot lower leverage. We're on the multifamily space. The government, Freddie and Fannie, they are super excited about being able to get into multifamily loans. That's what their mandate is. That's what they do. And it's a lot easier for us to get loans, and we can get loans for multiple units, and we can get loans with no interest for a period of time, which is, or sorry, no principal, interest only loans, I should say, for a period of time, which really helps on cash flow. Also, what they'll do is they'll take the loans and they'll amortize them over 30 years, but we'll basically have a 5-year loan period. And again, keeping the cost of the mortgage down. And interestingly enough, for those that don't know, often on multifamily, you can get what's called a non-recourse loan. So even us as general partners, we are responsible to pay that loan. If for some reason we can't pay the loan, it's a non-recourse loan. They don't come after you. If you go buy a single family home and you don't pay the mortgage, guess what? They're coming after you and repossessing your house. Big difference, right? There's a lot of tax advantages on being able to invest in commercial real estate, right? So you get various tax deductions related to maintenance, utilities. So we're able to take a lot of things and we're being able to do it. And then there's this beautiful thing called depreciation, right? So we're going to do a cost segregation. So when you passively invest in real estate syndication, they may do a cost segregation study. Instead of writing everything off for 27 or 39 years, we can accelerate the depreciation. So again, we're, thanks to the big beautiful bill, we're back up to 100% bonus depreciation. Give you a rough idea what that means to you is, let's say you were to invest $100,000, you're going to get anywhere between a $60,000 and a $70,000 first year passive loss. Now, I want to make sure that I'm clear. Passive losses, if you have a W-2 job, will go against passive income. So once this apartment complex starts paying you money, you can offset that income with your tax losses. And again, if you can't use it all, it's not a use it or lose it. You will be able to continue. It doesn't go away. And then, of course, if you're like myself, a real estate professional, it goes against all of my income. And then a lot of people will do this where they'll have one spouse be a real estate professional, and then the other spouse is working. So I have a friend, very high paid physician, runs a big department. You know, he's got $500,000 salary, paying $200,000 a year taxes. They started an apartment syndicating group, made his wife part of it. They started building up all this bonus depreciation, and he saved $200,000 on his taxes by being able to offset the bonus depreciation against their combined income. It's absolutely insane that the government allows you to do it. Again, love him or hate him, when Donald Trump was debating Hillary Clinton, he was saying, I pay no taxes. This is why. He's got a couple of other tax things he does. Do you know why Donald Trump owns golf courses? It's quite interesting. That blew my mind when I found this out. So he buys a golf course, and if you can take a portion of that course and turn it into natural preserve and donate it, so unprotected land, you get a 10 times tax deduction. 10 times tax deduction. So let's say it was $100,000 an acre. He's getting $1 million tax deduction on land that's swampland with alligators living on it in Florida, and he can't use it. Just think, it's just crazy the things the government does because they want to make sure that we're investing in real estate. So again, you're going to get these passes losses, and they're going to come in a K1. So at the end of the year, you're going to get a K1, and it's going to reduce your passive income stacking up against suspended losses. And again, we talked about the cost seg and the bonus depreciation. And again, I'm not a lawyer, or sorry, I'm not an accountant, but I love this. This saves me paying any taxes. So, and then there's diversification and stability, right? Multifamily help you diversify your risk, spreading risk across multiple units, reducing reliance on a single tenant. People always need a place to live. And we looked at that rent where that chart where people are not going to be able to get properties where they're not going to be able to buy homes. So they're going to be lifelong renters. And it tends to be a little bit recession resistant, right? Apartment prices aren't jumping up and down like housing prices. And again, during economic downturns, occupancy rates tend to hold steady and in fact might even go up, and it's lower cost for the single family home compared to owning it. So again, we talked about managing single more. That's the same one there. Oh, sorry, this is different. So yeah, single property. So again, we economies of scale, right? So we have one maintenance person taking care of dozens of apartments. So on our 200 unit, we have a manager, we have a leasing manager, we have a maintenance manager, and then we have two maintenance guys. And so we have all of this efficiency and all of these people. So we're not using third-party people for our turns. Now, we still may need to get some professionals in for certain things that happen, but we make sure that our maintenance folks, they have their HVAC license, they have their pool license, they have a lot of licenses so that we don't have to get the third party. And the professional management company, this is what they do for a living. They understand this, they're used to it, they have the systems, they have everything, they know how to market, they know how to fill the properties, they know how to take care of all of the rules and regulations for tenant laws. So if you're in the Texas, well, I'm going fast tonight too. We're going to finish early tonight. If you're in we might have more time for Q&A if you guys got questions. But anyways, if you're in the Texas market and you want to learn more about value add multifamily, I'm doing a tour on October 30th. It's in Sealy, Texas. I'll be all right, which is 40 minutes west of Houston, from downtown Houston, between Houston and San Antonio on I-10. This is one property we closed on 6 months ago. So on these property tours, what we want to be able to do is help you see what we did. So we bought this property six months ago. We're going to tell you how we implemented the business plan. When you buy a property like this, you have what's called lender required improvements. So how did we get the improvements done? How did we manage the budgets for it? We hired a new property management to come in. How was that turnover, right? Because one day there's another property management, the next day is our property management. We have to get people paying on our system, people getting maintenance tickets on our system. Plus this particular property, it's only 60 units, and it's actually, you can see it's very nice. There's 16 fourplexes, all identical floor plans, all 2-bedroom, 2-bath. 2 parking spots per unit, really, really nice with the parking in front, a lot of things with it. But if you can imagine, the guy who owned this had an office and a showroom. So 60 units, he had 2 units offline. So if you can imagine the effect on the NOI, just getting rid of having a show unit and just you do tours of the unit that's ready to rent, and not having somebody in the office. We hired a management company that manages a couple of properties in the area, and they have a property manager that's based there. So when they need to do a property tour or they need to meet a resident, they just go over there. It's 5 minute drive for them to go over there. We share a maintenance guy. So when we have to do a maintenance ticket, he just drives over and takes care of the maintenance ticket. So a lot of economies of scale, a lot of efficiencies that can happen. So again, what's my message? Don't wait to buy real estate and wait. So you still have time. We got the rest of this year, right? We've just, fall was 2 days ago. Do you know today in Austin, Texas, it's 100 degrees. It's crazy. We don't have fall coming here yet. It was actually a record, I think, today. It was 100 degrees. It was crazy. So again, I broke down the days that we have left in the year to be able to get things done. If you need help getting anything done, you need some motivation, just DM me. I'm here to help you. I'm here to make sure that you get to your next level, that you start creating your financial freedom, finish the year strong. So obviously, remember, we talked about this a lot before, right? You want to make sure you're balancing your risk, your reward, the time that you have your money invested, and you want to be somewhat stabilized in some asset classes. So even in multifamily, I'm invested in value add C class workforce multifamily. I'm invested in B class value add multifamily. I'm invested in A class new build multifamily, and I'm invested in A class new development multifamily. I'm invested in Tucson, Arizona, Texas, Denver, North Carolina. So again, you want to make sure that you've got a mix of places, right? So if all of a sudden something happens in one market, I've got some flexibility, right? So you want to make sure you've got that balance reward. And then obviously we do other things than multifamily. I just focused a lot about multifamily tonight, but you can invest in different asset classes. We showed before, we had the RV park that happened before. We're going to start getting in a little more into assisted living. We just bought some properties in Dallas. That one we didn't need to do a capital raise for, so I didn't get involved. But our goal is to build that little empire up. Now, I don't know if anybody's part of RE Mentors Ultimate Partnering, but I'm going to be in Dallas this Friday and Saturday. So if you do, let me know if you're in Dallas area. Just stop by and see me, but I'm going to be there on Friday and Saturday. And basically, this one is where they bring in all the folks in their mastermind, and you're looking for partners, you're looking for people to be able to do things. They have a lot of education, they have deal presentations. It's a very interesting time. And then for those of you, well, it looks like I only got one lady on the call. Rachel, thanks for representing. Jasmine is still going to do her meetings on the first and third Tuesday. She has everything booked up to the end of the year. So if you're interested in joining her, hers is a little bit different format, where she has guest speakers come in, some really great guest speakers. I actually help find them. I get a lot of my friends. I'm going to put the link for that in the chat. So if you want to join that, Rachel, she would love to see you there next Tuesday. And then, as I mentioned before, Transformational Tuesdays now only going to be the second Tuesday, so you're not going to get to see me as much. So all that means is you need to book a one-on-one call with me. And again, I keep talking about being passive, but I want to make sure that I'm clear. Actively passive means that you're educating yourself, you're learning, you're coming to these calls, you're coming to different webinars, you're coming to deal presentations. If at all possible, you're coming to our property tours. So we do property tours right now only in Texas. I did do one at our property in Dallas Denver, when I was there at another real estate conference. But we do a lot of things. So if you're in an area, we're going to start doing some more property tours. And then if you're interested in becoming active, we do have 3-day trainings. They happen in Texas. This next one's in Austin, then it will go to Houston, then it will go to Dallas. Just let me know. We can get you definitely interested in that. And then again, massive dreams need massive action. These are the three main partners of Massive Capital. This is Sanjay. He's actually who my very first investment in 2018 was with him, one of my original mentors. And so it's pretty cool to go full cycle and be on a deal with him. And then again, you're one decision away from a new life. It's time to take massive action. And again, I hope that my goal is 100,000 people to create financial freedom through real estate investing. I'm going to put my link in again to book a call with me. I talked extra fast today. I thought I had enough slides to go. Anybody have any questions? I talked fast. I'm just hyper tonight.
So Trevor, if
Escape.
I could ask, with regard to these communities, these subdivisions that are going up that are rental exclusive, and they have certain criteria for income and so on. And what do you think about those in terms of how massive capital to use those kinds of things? Are
So you're
they?
talking about build to rent communities?
Yeah,
Yeah,
yeah.
so we have not done a build to rent community. Some of our partners have, and in fact, we did a bus tour with one of our partners in Houston that does a lot of build to rent communities. And then I also was part of a mastermind pretty far back with a guy named James Kamasami here in Austin, and he's doing a big build to rent community. And those ones are interesting models that obviously, again, it's going after a certain demographic, but it's quite interesting. A lot of those communities, once they reach 55% sold to individuals, they can actually start selling to investors. So that's actually because we were going to do that in Georgetown. We have 10 acres in Georgetown. We were going to build 100 townhomes in Georgetown. Unfortunately, it was a nightmare with the city. 2 years negotiating with the city. Yeah, if you would only do this to your complex, we would approve it, spend about $10,000 redesigning and get on the city council meeting. And they would say, if you would only do this, we would like it. And then finally, after the third time, they said, well, we can't even get you water for that many houses for 2 more years, or sewage. And so now we're doing a mixture of retail and industrial development on those 10 acres. There's a big need for it. It's pretty close to I-35. So the front tenants will be retail tenants. And when I say retail, it's not like 7-Eleven, but it's businesses that will go more consumer shop there. And then the way we're about 100,000 square feet in total. And then the next phase of the property will be what I'm going to call you have a tile store and you need warehouse in the back for your truck, for your workers. So you may have a showroom in the front and a warehouse in the back. And then the back will be more just warehouses. But it's so on those build to rent communities, that model is very prevalent where once they get about 55% sold to individuals, then they start selling to investors. And especially for ours was a build to rent townhome community. And so we particularly did some fourplexes and some sixplex just to kind of make that a little easier to do. But I still think I've never invested in it and we've never done it, but I've got some friends that appear to be very successful. And again, part of what Warren Buffett's investment, those guys are building for sale homes, but they're also building for rent homes. And so, he's smarter than me. So let's listen to him. Any other questions?
It seems like RV parks are
Yeah.
really good investments. And can you just give us a little insight? I mean, it seemed that opportunity closed quickly. I mean,
Yeah.
what is it that RV parks is it just a high demand for them that's the big
It
draw?
is. So where this RV park was, there is a lot of transient people. So it's in a place called Ada, Oklahoma, and there's a big Indian community center there. And a lot of people come for retraining and, go to school there and do different things there. There's also a fairly big oil and gas. And then there's also a lot of construction work happening. So the RV parks are definitely a little more geared towards that type of market, to where you have those transient people living. So just to give you an idea, our typical lease there was 3 to 9 months roughly. And I'll just show you here. I just pulled up the slide just to give you an idea. So this particular one that we had, I pulled up part of the presentation here. This particular one we had, so we bought two parks. They have about 80 pads. These were existing pads, and this was some of their new development pads. And so this park is over here and over here. And so our business plan, so it costs about $10,000 to put this pad in and get all the power and utilities run to it. And then you lease it for about 550 bucks a month. And so, and you can see there's some over here. So our goal is once these are leased, we're going to build pads along here and then along here. And of course, you'll still let some things infill and make it look nicer. But this is the business plan of what we do. And then, so this park, again, two parks, put them together and run them as one, which was economies and efficiencies. They're across the highway, but that's like nothing, right? I mean, you can see there's a road that goes right over there. Nothing at all. And then, yeah, this is the other park. And you can see it's actually on a body of water. And so again, this one there was a total of 20 acres roughly. And so a lot of room still to develop on it. This one here we bought for 3.6 million. It was cash flowing day one. There's the sponsors. And this was an interesting business plan here. So they raised some capital, but they actually were doing the first 20 units were part of CapEx. And then the next ones were actually built out of cash flow. And they still were managed to be able to produce fairly good cash flow. Let me just find it here. So this was what it was, right? So there's, sorry, 93 plaids, I misspoke. And we're not increasing the cabins and other things. So 93, we're going to go to 113, then 123, and then 133. And then we're basically, our goal is to get it up and occupied and then be able to sell it to the next buyer because we would have increased the NOI to be able to do it. Let me just find, and this gives you roughly on here. So again, this one here had a very high return. I think that's why it sold out well. And it had, so in year one, I was going to produce on the 100,000, about 7,300, 7,500, 10,000, 13,000, and then your profits from sales. So this one was a 2.65 multiple. Really, really good deal. So producing just over 11% on average cash on cash. And that's where it's located, right in this area here. So 3 miles from a university, this is the Chickasaw Nation. There's a super Walmart, there's a Coca-Cola bottling factory, Starbucks, got to be near a Starbucks, right? So again, it's not a space that I'd actually did about much more. Awesome. Any other questions?
Hey, Trevor,
Yep.
when it comes to multifamily, do you just focus on what is it, the triple net lease? I mean, the rent, the all-inclusive rents, or?
No, so depends which property it is. So our property in San Antonio is all inclusive. So is our one in Pasadena, but all of our other multifamily are plus bills. So those two properties are all inclusive, and they attract a certain demographic that just needs to know they're all in cost. And then just to let you know on those particular units, like their thermostats are capped off. They can't go below 68 and above 73. Just so we don't end up paying the power bill. But so most of our apartment complexes, other than those two, tenants pay their rent, then they pay their own utilities, they pay their own water. And then we do better on some of our other properties with paid parking. These particular properties right now, we're not getting anything on paid parking.
Okay, thank you. That makes sense.
Yeah, awesome. Just for those, just sharing some personal thing, I'm going to go to Canada for the month of October. So the next time I see you guys, I'll be up in Canada. That's where I'm originally from. I'm from Canada. My daughter's up there. I have 2 brother-in-laws, a sister, nieces and nephews, and we have Canadian Thanksgiving is early. So I'm going to travel up, see my daughter for a couple of days, go up to my sister's, spend Canadian Thanksgiving with her. And then my daughter, I can't believe I'm this old that my daughter's turning 40, but we'll be up there for her birthday. So looking forward to that. And then I'll be back in time to do my property tour on the 30th. Awesome. Well, thanks everybody for showing up. Really appreciate it. We will see you in 2 weeks. Take care.